Hello, this is CyberDragon. Today I'm going to talk about U.S. Tax Lien Module 2. What this video will cover is how tax lien works in more detail. And this is a 7-part video. Don't forget to like, subscribe to my YouTube channel. Share this video to everyone so they know about it. And let's begin.
Hello everybody, Tony Martinez here with the U.S. Tax Lien Association and want to welcome you to Module 2 of our Accelerated Tax Lien Certificate Investment Mini Course. I'm here with my business partner again, Mr. Sean Higgins.
How's everyone doing?
And today what we're going to be talking to you about is the tax lien certificate investment process and exactly how the money gets put into your pocket.
Absolutely. There's really only a couple of things that can happen in this, but you have always 3 people involved in this. You've got the county, you've got the property, and you've got you and I, the investor. Okay, for this example, we're going to use a property, Tony, let's say that has a fair market value of, say, $150,000.
Perfect.
Okay, let's say 18% is going to be the interest rate, and there's a $500 lien. They haven't paid taxes on $500 of their property taxes.
And let's say that there's just so you guys understand.
Say there's a mortgage on it.
Yeah, there's a mortgage on it. And there's always a redemption period. That's the grace period,
right,
in which a person, that's the period of time people have to come in and pay off their delinquent tax bill. Now, redemption periods range all across the United States. 6 months on the low side, up to about 3 years on the high side, depending on the county. For this example, let's use 1 year.
Let's use 1 year. So what happens is this. Once the property owner has been delinquent 1 year with the county, now the county will offer those up to people like you and I. And in this case scenario, we put up the $500 to the county. Now remember, the county is your workhorse. They're going to do about 90% of the work for you. In return for putting up this money, they're going to hand you a certificate. It's going to go on file down at the county courthouse.
Right.
And in this particular scenario, it's going to be paying 18%. Now the redemption period comes in that Tony was talking about earlier. In this case, we picked 1 year, right?
Yeah.
So that property owner would have 1 year to come in and pay off those delinquent taxes plus the 18%.
Here's what's important as well. That 18% penalty, that 18% interest has already been added to the property owner's tax bill. So that money is already there. Whether we buy the tax lien or not,
it exists.
That 18% gets put onto their tax bill. So we're not causing
you're not creating something to
Right.
happen as an investor. It's already there.
Right.
The county needs that money like we've established in the first module.
Right.
Schools, bridges, fire departments, et cetera, et cetera.
Right.
So they're willing to give that up to the investor and when the property owner pays.
Right.
So the property owner pays the county. The county, now this is where it gets really fun. Once
Right.
the county gets this money, they can't drag their feet. This
Right.
isn't some government bureaucracy that gets around to it when they feel like it. They've got to cut you or me or whoever the investor is a check for the full investment, in this case $500, plus 18% within 5 to 10 business days. Now think about it. You're making 18% on your money. What are the banks paying right now, Tony?
About 1%.
Exactly.
About 1%.
I don't even know the math on there. 1,200%. It's so much higher. It's unbelievable. Now that's all fine and dandy if the property owner comes in. Okay, so they paid it. You got your money. Everybody's happy. The second scenario, and the only other scenario, is if they didn't come in within that 1 year amount of time.
Right.
And Tony, why don't you explain that? If they don't come in within the prescribed amount of time, what happens at that point?
Yeah, so all you do is this. Remember, the county government is your workhorse. Up until this point, they do everything. They handle processing all the paperwork. They handle all of the accounting. They handle all of the notification. So what you're going to do is you're going to contact the county. You're going to let them know that the redemption period on your tax lien certificate has expired. Right? And what the county government's going to do is they're going to take that tax lien certificate and that property through a judicial process, what we call a property tax foreclosure. It's a legal procedure, and they do the legal procedure by the law of that particular state. And what happens is this. In that process, the county government is, by law, has to send out certified letters to all the other lien holders, giving them an additional 6 to come in and satisfy that tax lien. Now, make no mistake about it, once those certified letters go out...
Now wait, let's explain who is going to... Anybody that's got a financial interest in that
Right.
property, right, Tony? First position lien, the bank. second lien holder, a mechanic's lien, anybody that's got a financial interest in that property would be obligated to get notified by the county.
Exactly. And make no mistake about it. Let's say 6 certified letters get mailed out, and let's say no one responds to the letter. What happens is this: by law, when that foreclosure process is complete, all other liens, junior to the property tax lien, are wiped, clean, and extinguished from the property. And that is the actual law that dictates that. So the mortgage would be wiped clean from the property, and you would own the property
Free and clear.
free and clear with no mortgage on it for the price of the back taxes, penalties, and the foreclosure process.
So think about this. In this case scenario, we picked $150,000, right?
Right.
$150,000 property, $500 in back taxes. Let's say for this example that the fees and penalties were another $1,500.
$1,500
So for
is fair.
$2,000, you've got yourself a $150,000 property. Is that a good deal? Absolutely. But let's back up for a second. Tony and I aren't here trying to teach you how to buy a $150,000 property for $2,000 in back taxes. Some way, somehow, probably the property owner is going to figure out a way to come up with this. But make no mistake about it. There's no ambiguity. There's no black and white. You either get the property or you get the interest rate. Those are the only two scenarios that can take place in this example. So let's talk about the bank, because that's a big one that comes up all the time. What do you mean the bank can be eliminated? Well, let's get real for a minute. Remember, backtrack just a couple of minutes ago, Tony said that everybody has to get notified by the county or whoever's doing the foreclosure. That would include the bank.
Right.
Okay, imagine me, the bank, I get this certified letter going, oh, wow, we've got this mortgage on this property, and they're being foreclosed on for delinquent taxes. They know how the law reads. They know they're in second position to a tax lien, and that they have the legal right to do this. So the two things are going to happen. They're going to call the property owner up and say, hey, what happened? What's going on? They were on vacation. They didn't know about it. They slipped their mind. Whatever the case might be, if the property owner didn't even have the money to protect their mortgage on this property, the bank's probably going to come down to the county to pay off the delinquent taxes plus the interest rate. Let me ask you this question. Do you care where the money comes from?
Right.
No. Last time I went to the grocery store, they didn't ask me where I got my dough. You know what I'm saying? So you get that money from the county, it's been processed, and you make your 18% either or. But make no mistake about it. If the bank, if the property owner, whoever does not protect their interest in that property and that time period expires, you will own the property free and clear.
Well, and let's talk about the bank. I'll take it one step further.
Right.
And I'm talking to you, the listener right now, the student listening to this video. If you were the bank and you received a certified letter saying that you were going to lose a $150,000 mortgage because of $500 in back taxes, what would you do?
Right.
And if you were the bank,
small price to pay.
Yeah, and you're probably saying, okay, I would go down and pay. Well, of course you would, and most banks would, but not all banks do. But
let's talk about why.
Okay, so let's
talk about the current situation.
Well, why wouldn't a bank do it? So first of all, I want to give you some facts, and this is an absolute fact, and you can look it up. 40% of homes in America don't even have a mortgage on it.
Right.
So there's no bank involved to begin with in that scenario. Over the past 2 years, as we discussed on the last video, 257 banks have went out of business in the past 2 years. So think about 257 banks.
They all have mortgages on properties.
They all had mortgages on properties.
Those were transferred to somebody.
Right. So what happens to all of those?
Right.
So that is a fact that what we've seen over the past couple of years, we've seen more properties with bank mortgages get acquired because of that scenario. Then what you also have to remember is this. Right now, as I'm speaking to you, banks have the highest level of bank-owned property inventories in the history of the United States. The question is, are all banks keeping track of all of the records of every delinquent property in their inventories right now? My guess is no.
Probably not. And here's another thing, folks. Listen, there's two scenarios we're going to be teaching you this, okay? Just so we can wrap this up, and we're going to get to tomorrow's module here, is this. You know, if the bank is on there and they don't protect themselves, they go away.
Right.
Why? I really don't know why that is, but here are some great scenarios that Tony's talking about here. But the bottom line is this: regardless of it, the investor are protected, regardless of what happens. If the bank decides to protect themselves, great. You've got yourself a situation where you get 18% in this case scenario. If they don't, you get the property free and clear. Now, as we get through these modules, one of the things you'll see is if you want to get interest on the property. We'll show you how to do that every single time where you get redeemed. I don't want to have to deal with the property. We'll show you how to guarantee to get redeemed every single time.
Right.
Some of you invariably are going to go, you know what, I want that property. And we're going to show you how to do that every single time. Keep in mind, tens of thousands of clients, students that we've helped over the years. We've got the data. We've got the science behind this process to back that up. So either one you want to do, or both.
Right.
We're going to show you how to do that.
Okay, so I want to just summarize real quick as we close this video out. And so I want you to put yourself in the position of the property owner just for a second. You wouldn't lose your home for a few $100s in back taxes, and most property owners wouldn't. So typically, if a property does get taken back, it's typically not a person's primary residence.
You and I have never gotten a property back where the homeowner lived in the property.
Right.
If that happens to you and the owner lives in the property, financially speaking, I think we can all agree that they're not in a very good position. Don't kick anybody while they're down. Call us up. We'll give you a couple of solutions for that. We'll give them one right now.
I mean,
here's an easy one.
If I took back a property today and there was a family living in the home,
right?
Here's what I would do. I would rent the home back to the property owners until they're back up on their feet.
Right.
Then I would sell the property to the property owners and I would carry the mortgage myself.
Maybe even using their rent as a down payment.
And using the rent as a down payment.
See, here's the thing is, you've got an option. Think about this, Tony. You and I have got an option. The county doesn't.
Right.
Because the county is going through this process whether we invest it or not. If the county were to take the property back, they would have one choice and one choice only. Vacate the property so they can execute a sale on it and move forward from there.
Exactly.
You and I can do different things.
So there's really two outcomes. When you invest in tax lien certificates, and I'm going to give a caveat to this, when you conduct proper research
Right.
and you acquire tax lien certificates on the right types of property, there's two outcomes. Outcome number one is the property owner redeems and you get your 18% interest on your money. Outcome number two, the property owner does not redeem and you will own the property free and clear of all liens and encumbrances with no mortgage on it for the price of the back taxes and penalties only. Make no mistake about it, that is the law. The law is black and white and there's no gray area.
No gray area, no
the law.
ambiguity there at all whatsoever.
So let's do this. As we wrap up, let's wrap up the exact same way we
Absolutely.
did yesterday. And what I'd like you guys to do right now is, again, post a comment to create the dialogue around this training session specifically. So here's what we'd like you to post, is what's the greatest takeaway you got from today's training session? What's the greatest lesson you learned, the most valuable point you got out of today's training session?
Right.
Post it in the comment section. Let's create a dialogue around that. And then secondly, based upon today's training session.
What kind of questions do you have?
Yeah, exactly.
What are you going, wait a second, I get this, but I don't get that. Whatever.